So I think that adds to the defensive thesis, especially the lack of quantitative easing and the potential beginning of quantitative tightening. That makes it a little bit more tricky for asset prices to keep growing. That doesn't mean it's impossible. I mean, there are periods where asset prices can go up quite a bit. But I think that given the other factors, declining PMI environment and tightening policy, there's kind of if you run kind of a back test on that scenario, it's pretty poor for asset prices. And so a lot of that's already been kind of priced in, right? So the market's already front run the Fed, for the most part, and other central banks. Um, I'm not sure they're going to be able to get as tight as they are saying that they're going to get. I think they're going to try to tighten until something kind of
Mm.
forces them otherwise, right? So until, credit markets get illiquid, treasury market gets illiquid, or recession indicators start to kind of pound them, I think they're going to try to tighten. And so I think that that's kind of a choppy environment, a challenging environment for a lot of asset prices. But I think a lot of that's, it's going to come down to whether or not they end up tightening more than the market expects or less than the market expects, because the market already has anticipated a certain amount of tightening. And so basically what's hard is that they're tightening later than they normally would have, right? So kind of like how in late 2018 they had already been tightening for a while, but then growth started to slow down, and then, so that's when they ran into a problem when they were going about autopilot tightening at a time when you had just economic growth rolling over, and so eventually had illiquid credit markets, and they had to turn kind of turn around, do the famous Powell pivot, and so I think that they're kind of in a similar situation. It's obviously a little different, but I think that they're in a similar type of environment where they're trying to tighten into a slowdown, and I think it's going to get messy at some point. I just don't know exactly where that mess is going to show up. I mean, I think there's kind of self feedback loop where if they tighten too much, they strengthen the dollar, they increase hedging costs, foreign sector doesn't buy as many treasuries. Banks are already stuffed full of treasuries, right? They've been huge buyers of treasuries, and if they then start to do quantitative tightening, they start to let maturities roll off. That kind of squeezes the treasury market. It could get a little bit of liquid, and so I'm not sure how long or how far they're going to go with the tightening. I'm going to kind of take the under, even though I don't exactly know how high rates are going to get, how much they're going to be able to shrink their balance sheet. I think it's sooner rather than later is when they run into an issue.
If I understand correctly, where you lie on your base case macro thesis is that we are going to be facing still some inflationary pressures, although maybe slightly declining, but still there, pretty aggressive inflationary pressures at a point where PMIs are slowing down and monetary policy tightening will compound this growth slowdown. So in this cyclical environment, Lyn, what are the asset classes you look at for places where to hide? There are not many. If you look at year-to-date returns, they're pretty bleak across the board.
Generally, I like a combination of energy producers, energy transporters, healthcare stocks, gold, cash equivalents, kind of the middle of the curve, maybe 2-year treasuries, things like that. And then I do have some barbell, like I have Latin American equities, I have Bitcoin, I have a small number of kind of these network effect growth stocks, right? Very small positions. So I have some of a barbell going on, but I'm kind of weighted towards kind of defensive value, and ones that are not heavily tied in a supply chain, and basically some liquidity in order to rebalance into any sort of downturns you
And
might have.
Lynn, what are the signs that you would be on the watch for to turn around on that thesis?
One would be basically improving rate of growth metrics, right? So, maybe an opening of China. We're starting to maybe see that some of these extreme lockdowns are easing. They might have already hit peak lockdown, and that they're maybe slowly coming out of that peak level of lockdown. But I think that could also potentially exacerbate inflation, because that means more demand could be opening up if China kind of starts stimulating a little bit. That could actually impact inflation, and so really it's kind of watching for changes in the growth itself. And so I think I would look at signs of how much banks are lending, and things like that. And that's why I'm not completely devoid of risk. I think, I would kind of balance it based on what's happening. And that right now, until I see evidence to the contrary, I like that somewhat defensive positioning, but it's not like a super bear, like, hardcore bear, don't own anything that's risky type of a portfolio. It's just a waiting.
I had a discussion with Michael Gayette earlier this week on whether it makes sense at all at any time, a point in time in history, to be cash loaded as a private investor. My answer is no. Do you have a view on that, Lyn? Does it make sense to be cash loaded at any point?
I think probably not. I think there are times to have a little bit more cash equivalents than others. Basically a little bit more rebalancing fuel. Um, you'd have to have a pretty high conviction view on both direction and timing in order to have a lot of cash, right? So, maybe if you were, for example, one of the people watching the subprime mortgage crisis and had a high conviction was going to blow up in the next year or two, you know, having a lot of cash would be useful there. Um, but other than that, I think that generally cash is kind of designed to lose value over time. And I often joke that it's kind of the one speculative asset I own because it's the one thing I own that I know is going to get worth less over time, but that I still own some based on the speculation that some of the things I actually want to own might get cheaper, and then I might be able to rebalance into that. And so it's all about a percentage in my view. Now, if a trader, it's obviously also different between a trader and an investor. If someone's a trader, they can go to a complete cash position until they kind of realign what they're looking for. Whereas if you're actually just a long-term investor, I think that there's no reason to ever be 100% cash or massively cash.
Yeah, it's a very good point. Actually, cash, you can see that as a relatively expensive optionality from a real rate perspective. So
Exactly,
inflation
yeah.
keeps on eating you away, and the time value of that also compounds against you. So it's a relatively expensive optionality, but owning some of it, it depends from your risk tolerance. 100% cash is quite an interesting position. I should agree with you guys there. But Lyn, I mean, we talked about plenty of stuff, pretty short and sweet so far, but in every macro trading floor episode, we're going to ask our guests to be clear about what's the macro trade. So here is the question. What's your macro trade?
Yeah, so I like energy pipelines here. And the reason is I like them on multiple time frames. So there are a number of things I like long term that I have no idea what's going to happen in 6 months. Let's say Bitcoin, right? So it's got a mild uptrend, but I don't know what's going to happen in the next 6 months, even though I like it for 5 years. But in a declining PMI environment with supply chain issues and kind of the stagflationary type situation, I want something that I like for the next 5 years, but that I also, I think has a reasonable prospects over the next 6 months, 9 months, 12 months. And so, we've had a big run up in energy producers. I still don't think they're expensive, but energy pipelines have kind of lagged. And they have less overall sensitivity to oil prices. They still have some sensitivity because it can affect the producer volumes, and therefore it can affect their volumes. And in the past, you had pipeline companies blow up when you had energy price crashes. It's because they were over levered, right? So they were reliant on constantly issuing debt, constantly issuing equity, and so even if their underlying business was not impacted too much, their whole financing model was. It was basically reliant on unlimited capital being able to, being willing to buy all of their types of liabilities. And so in the past several years, you've had now two blowups in the energy U.S. energy pipeline space. The first one was back in the whole 2015, 2016 period, and then you had another one during COVID that kind of took out some of the stragglers. And so now that the dust kind of cleared, I actually really like that space. I think it's more appropriately levered, given it's still an asset heavy business, kind of utility like. So they of course they have some leverage, but it's now back down to very reasonable levels. And I think that they're kind of well positioned here. Their valuations are totally reset. And there's a couple ways to play it. One is you can focus on the really high quality names. So, for example, I like Energy Products Partners. EPD is the ticker, and they're one of the ones that never blew up, right? So they never had to cut their distribution. They never got over levered. Whenever these slowdowns would happen, they just would kind of stagnate for a couple years and then resume growing. So they'd run into headwinds, but they wouldn't blow up. Basically very well managed, very diversified. So it's not just oil, right? It's oil, it's natural gas liquids, it's petrochemicals, right? So a lot of different types of energy and refined products transporting and storing and exporting. And so with, say, Europe's energy system crippled at the moment, and basically still a long-term prospect for emerging market energy demand growth, I think that basically the U.S. is well positioned in terms of energy production and then particularly energy transport. And so I like that space quite a bit. And you can also play it with the ETF for the space, which is AMLP. So one of the downsides of pipelines is that a lot of them still are structured as partnerships, and so they issue a K-1 form. Basically, at tax season, it gets a little bit complicated, and that actually keeps a lot of fast money out of it. And keeps kind of the valuations a little bit lower, a little bit more frictions, which is really good if you're a multi-year investor. You get higher distributions, you get better compounding. But if you want to get in for 9 months and then out, then something like the ETF could be a better way to play it.